This week in economics on the 12th of July 2015. Numbers man here, and we have a very interesting situation developing with the Troika and the Greek government, in particular the Ministry of Finance there, and the talks that are going on. Part of the problem there is two views. The modernistic view that is voiced by many in 2015, that austerity in itself harms economies. And some of the European ministers, finance ministers in particular in Germany, that there must be sacrifice on the part of the Greek people. There was a referendum that said no, and obviously the consequences are now being felt. The banks in Greece, no doubt, will collapse, and that is an unfortunate situation. But at the same time, their economy, that is in Greece, can be rebuilt, as the same situation happened in the Russian Federation post-USSR. Thus, the Greek people are in for a very long and painful struggle. Either way that this thing goes, but to privatize some of their basic industries is obviously not the way to go. VAT increases there is not the way to go at this period. Now, if the Greeks exit the EU, then of course they can revise their various tax collecting methods based upon the best available practices. Now, what will happen at the end of these talks? There's a lot of noise going on now, but the reality is that there's roughly 3 trillion euros out there that would go up in smoke, so to speak. And Germany in particular is owed billions of euros that they perhaps would virtually never collect. Now, there is President Argentina did this to reset the debt, and that is what the Greek people should want to do. But right now, the Greeks are wanting reduction in terms, and that would probably be granted, but they need immediate cash. Now, if they cannot negotiate immediate cash, there is no other juncture than to exit the euro, and it will have financial consequences for many of the nations that are owed money. Their deficits will have to be reset, and Germany in particular will bear some of the brunt. It's more the political consequences and the economic consequences at this particular time. And this is where the Greek people see themselves, and the Euro nations, the Troika, is at this time. The talks were, according to the BBC, they had a summit, I should say, scheduled for today, and it was canceled, and the talks go on. But they cannot talk forever. There is a need for immediate action, and part of this problem is the setup over many, many years that the people of Greece became dependent on the EU for financial stability. In fact, the European Central Bank, the IMF, etc. And the IMF had used these austerity policies before throughout the world, and they have denounced their own policies of austerity. The chair, Madame Lagarde, has talked about this many times, but yet they're still using this tired old practice of austerity, and that only weakens the economy, makes things much worse. And if you look at modern industrial nations today, stimulus is the way. Now, in Greece, obviously, they're in no position at this point in time to do a stimulus. However, if they do, in fact, leave the Eurozone and use their proverbial currency, given that most of the Greek economy is an inward economy, it's not interconnected. They do have tourism, they have a lot of ships, etc., that are registered there. But those things can be adjusted. And if they go outside the euro and use their own currency, they will still have tourism depending on how they do that. They could always peg it to the dollar. There's many things that they can do at this point in time. But the next few months, no doubt the banks have to get recapitalized, and that is a big problem. Now, people there, and many of them have removed much of their liquidity from these banks that could. Now, pensioners, obviously different situation there, but many of the people that work in the international economy and have bank cards from the MasterCards and various others of the world that issue these types of things and have accounts abroad, they will be able to continue with a life with some adjustment. And those people have already made their adjustments. But the Greek financial people have to plan ahead without the Eurozone because there is some reluctance there. But this is use an American term, a bluff situation, playing chicken. But it doesn't work in these kinds of episodes. Now we'll go to the international situation. As far as editorializing, yes, that was an editorial, but at the same time, most of what you hear these days is in fact rhetoric, editorializing. The facts, yes, they are laid out, and we have laid them out in some of our episodes here as to how much money they owe. Paul Klingman was talking about that in his column in the New York Times, but many commentators have talked about that, and sometimes, as the late American leader Lyndon Johnson used to say, you can talk an issue to death. But we'll go to the World Outlook. This was released on the 9th of July by the IMF. And effectively, we'll just read some of it here so we can go to the fact and not rhetoric. Global economic growth projected at 3.3% in 2015. Marginally lower than 2014, with a gradual pickup in advanced economies, slowdown in emerging markets and developing nations. In 2016, growth is expected to strengthen to 3.8%. Now, this would be in line with some of the presidential candidates in the U.S. talking about a 4% growth in the U.S. economy. Can it be achieved? Yes, but not in a vacuum without the rest of the world. A setback to activity in the first quarter of 2015, mostly in North America, has resulted in a small downward revision to global growth for 2015 relative to the 2013 World Outlook, Economic Outlook. Needlessly, the underlying drivers for a gradual acceleration economic activity in advanced economies, easy financial conditions, more neutral fiscal policies in the Eurozone, lower fuel costs, and we'll talk about that in a minute, improved confidence and labor market conditions remain intact. In emerging markets, the continual growth or slowdown reflects several factors, including lower commodity prices, higher external financial conditions, structural bottlenecks, rebalancing in China, and economic distress related to geopolitical factors. A rebound in activity in a number of distressed economies expected to result in a pickup growth in 2016. And that we look to the present day situation. So this forecast will no doubt have to be altered. Distribution of risk to global economic activity is still tilted to the downward side. Near-term risks include increased financial market volatility, disruptive asset price shifts, while a lower potential output growth remains an important medium-term risk in both advanced and emerging markets. Lower commodity prices also pose risks to the outlook in low-income developing economies after many years of strong growth. No doubt, this can be seen in some economies, the Russian Federation, for example, Venezuela, and various other low-energy prices. However, what happens is at a certain point, economies adjust and accommodate the circumstances. The weak first quarter growth in the first quarter Q1 2015, the starting point for the update of the IMF's global forecast, world growth at 2.2% fell some 0.8 percentage points short of the forecast in the April 2015 WEO. The shortfall reflected to an important extent an unexpected output contraction in the U.S. with attendant spillover to Canada and Mexico. One-off factors, notably the harsh winter conditions, port closures that was out on the West Coast in Los Angeles and Seattle, as well as a strong downsizing of capital expenditure in the petroleum sector contributed to the weakness. Outside North America, positive and negative surprises were roughly offsetting. Growth in output and domestic demand in emerging markets and developing economies broadly weakened as expected. Oil prices have rebounded more than expected in Q2, reflecting a higher demand expectation that oil production growth in the U.S. will slow faster than previously forecast. Needlessly, the average oil price expected for 2015 is at $59 a barrel U.S., in line with oil pricing. Assumptions in the April with somewhat small increase forecast there beyond as the global oil supply runs well above 2014 levels. We'll get to that in a minute from the international agency there. Global oil inventories are still rising. The reduction in oil investment may, however, lead to somewhat weaker boost activity in North America from lower oil prices than expected earlier. Inflation, with the rebound in oil prices, fuel end user prices have started to rise. Monthly headlines, inflation has thus started to bottom out in many advanced economies, but the impact of disinflationary factors early in the year was stronger than expected, particularly in the U.S. Inflation has remained broadly stable, well below inflation objectives in many emerging economies, notably those with weak domestic demand. Headline inflation has declined. Rise in bond yields have risen to about 30 basis points in the U.S. and about 80 basis points on the average in the Eurozone, excluding obviously Greece, since